This is the Financial Thought Exchange podcast, where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Lotta Moberg. My guest today is Philip Maymin. He is the portfolio manager and director of asset allocation strategies at Janus Henderson. He's also the Endowed Schramm Chair of Analytics at the MSBA program director at and the MSBA program director, at Fairfield, Dolan, and also CTO for Swipe.bet and instructor at Analytics.Bet. So that's sports betting, just like it sounds. So very eclectic mind. Thank you for being here. Welcome.
Thanks, Lotta. So great to be here.
So as I mentioned, really interesting background. Let's jump into the sports analytic just to understand where this is coming from. How does a person combine that experience with finance in the finance field, and what has been the journey in doing both of those things?
About maybe 12, 15 years ago, the MIT Sloan Sports Analytics Conference started a track on research. And my brother and a great friend of ours, we thought, wouldn't it be cool to take all the quantitative tools and techniques of finance and try to apply them to sports? So we started writing some research papers on sports. I think our first one was on early foul trouble. We thought this would be an easy one, right? And use some options-based decision-making, like why keep your best players, even if they're in foul trouble, why keep them on the bench? Because wouldn't you want to maximize the amount of minutes that they play? And surprisingly, this happens a lot in sports analytics. We did a lot of work, a lot of quantitative analysis, some options valuation, right? And it turns out that coaches basically have it right. They kind of know what they're doing. It's surprising. The experts are, in fact, experts for a reason. We found that there are very common use cases where you do want to keep your best players on the bench, even when they're in foul trouble, even though you do want to maximize their minutes, because the option value of having them in at the end of a very close game is so much more valuable than just having the drift, the additional per unit production that they might add otherwise. So from there, once you get into sports analytics, sports betting is not that far off, and it's all kind of the same thing, right? Once you do analytics, everything, the world looks like analytics.
That makes me think about like evolutionary psychology in economics, my field, where you end up doing exactly that. You find an anomaly and people beat it to death, or they're going to find why it's so irrational and figure out in the end that actually there was some reason to it.
I agree. That's fascinating, especially from the evolutionary perspective, because as you know, we're humans. It has a lot to do with AI, actually, what you're saying, because ultimately. And with trading strategies, if there is an optimal, there's lots of different ways of getting there, right? So truth tends to converge, which is a beautiful thing. And so whether you're looking at it from what happened based on evolution or what should happen based on a model of decision making, you kind of end up often at the same place. And if you don't, the disconnect is not necessary. Sometimes it's the case that the evolution is wrong, right? Maybe there's just a better way of making a decision. That can happen. But usually there's something wrong with your model unless you're matching most of the time.
Yeah, fascinating. Yeah, for the people who are watching here, you probably clicked on this video because we are going to talk about AI very much so, AI and finance. And if for somebody who is technically minded, maybe familiar with gradient descent, if you can think about it, when you say there are many ways of getting there, well, think about kind of an environment, right? You walk a path, and just like in the forest, you can walk to the highest hill, but there are several ways of getting there. And there's a mathematical equivalent to that is often applied in this field as well.
Yeah, that's true. It actually raises what I think, and I'd be curious to hear your thoughts about this. David Deutsch, quantum physicist and inventor of quantum computation philosopher, he's pointed this out a lot, that the way we currently do AI and ML, we have a goal that's trying to maximize some objective or minimize some error, right? There's a goal, and it's looking at errors and trying to reduce that error all the time, billions of iterations. That may be the exact opposite, he has argued, of what creativity is, right? Where you don't necessarily have an objective, or at least you can question your own objective. So his argument is that AI, in the current way we do things, where it's trying to get to the maximum, right? Get to this optimal point, it can't be general intelligence. It can't have human level creativity. How does that argument strike you?
Yeah, so the way that I'm like this really much, if we think about evolution, we're talking about mutations, right? Like you get outrageous, sometimes outliers when new creatures are born that are just evolutionarily waste and they die off. But sometimes that's actually exactly what you needed, and you get faster to this point, or not even faster, to a point where you would never otherwise have reached. But I think like in the field of AI, maybe I'm referring to it wrong, just AI might be more reinforcement learning thinking, but it's you do think about exploration versus exploitation a lot, where exploitation is often like, well, I'm getting closer, I'm using 99% of what I'm doing is by my experience in the past, versus exploration is let's just throw something out there and see where I land and see if that actually gets me to a spot that is more interesting. Now, those leaps can be more or less radical, right? So I don't know how radical they usually are, but I think of those as a little bit of throwing the dice, evolutionary dice too, and see like what happens if you get, bigger changes than your priors would somehow suggest or obviously deduce you to make.
Interesting. So yeah, if we think in terms of like generative AI, making images or now videos, which are amazing, or even just the text that we're come to think as granted, even though it's still magic, like ChatGPT or Claude, they do generate and they have some, like the art. So we did an AI art exhibit at Fairfield for graduate students. They created their best self portraits, a portrait of their best self using AI. And if you played with these tools, you can see that it's an opening of a vista. I'm not an artist. I can't paint. I can't draw. But typing words and having someone else draw what I think is cool, that's a skill that I can do. And a lot of that opens the world of art and creativity to millions of people who wouldn't have been able to have it before. And same with the writing, the ChatGPT. Like I'm sure you've used it for fun things too. A year or two ago, I used to have it generate a new Dr. Seuss style bedtime story for my son, and we would read it out. And it's instant, right? It has his name, it has space, and dinosaurs. It's fantastic. So there is a sense. It's a very curious distinction. There is a sense in which it can be creative and generative and create new things that you would have never done, especially rhyming. Like you'd have thought rhyming is hard, right? But it's like boom, done, instant. It all rhymes. It has the same flow, and the images look right. So it can become hard to see what the distinction is. And yet, when you use these tools, maybe it's species bias, but it feels like it's missing something. There's some connection there that isn't quite human.
Yeah, absolutely. And in this conversation, I want to make sure that I, to some extent, use the right words here. There is this important distinction, right? Right. We throw AI out there, artificial intelligence, machine learning, other concept that is often used in this context. Maybe you would help us describe kind of the difference between them and how to think about when we should use what, or think in different ways here.
Yeah, they're essentially, they used to be synonymous until a couple of years ago. And the old joke is, if you're starting a company, you're obviously doing AI, but when you're hiring people, you're hiring machine learning engineers, right? ML is a form of AI. There's lots of ways of arguing it. Machine learning is very simple. There's two kinds. You're either supervised or unsupervised. So either you've labeled the examples or you haven't. And there's two different branches and kinds of things you could do there. But ultimately, you have data and you're asking the computer to either categorize it or classify it, or learn based on the examples you give it and then generalize from there. Nowadays, I think that when people say AI, they mean basically ChatGPT and similar things like Claude. It kind of means generative AI. You don't hear a lot of people talking about AI unless it's generative AI nowadays in the past year or so. Deep learning is a form of machine learning where it's a combination of a neural network, which has been around for 50 years, but it has deep hidden layers and some structure to it. And that's typically been driving a lot of the big things that have happened in AI over the past 10, 12 years or so. But AI itself just means it's a moving goalpost, almost by definition. 50 years ago, AI was the idea that, well, if it can beat or even play at the level of humans in chess, that would be AI. It would be artificial intelligence equivalent to human intelligence. But that goalpost kept moving once they could be better at chess and so on, and Go even. So now I think AI is typically used synonymously with generative AI. Like if you talk to people in business, you're like, hey, how are you using AI in your business? They understand that you mean this form of generative AI and the new things that's happening. And now the new ultimate goalpost is called AGI, Artificial General Intelligence, where it would be human level and indistinguishable from human.
But so is deep learning a part of, if I use ChatGPT, is that in the background, or is that a completely different part, like that would not be implemented?
Oh, no, it uses deep learning. It uses the new technology, I don't know, how old is it now, 7 years or so, or 5 years, transformers, which is a technology that GPT stands for Generalized Pre-trained Transformers, generative. The transformer is a type of deep learning architecture where it's based on attention, and it's trying to remember where things are relative to itself. It replaced an earlier technology that was more like a recurrence relationship, things like long short-term memory or other kind of gates that's trying to, in the context of text, you're trying to understand how this word relates to other words. And transformers help solve that in a very general way, in a very powerful way. What you do with deep learning is you set up the structure. And you say, I don't know what the values of these parameters are, but I know the structure should be kind of like this. And then the values of the parameters are learned through the process we were talking about of minimizing the error to the known examples. So yes, everything is running ultimately on deep learning. Deep learning is not going away. But there's such a big gap. It used to be deep learning would be the model that you run, and then you look at the output. Like you can try it running it for NBA, right? If you have a bunch of data and a bunch of players and prospects from college and international, and you're trying to forecast what they're going to be like in a few years, or you have text data sets and you're trying to forecast what that means for the sentiment or spam attribution, things like that. You have the deep learning model, then you have the instant application. Nowadays, there's a bit of a jump. So you have that model, that is the GPT model, and then ChatGPT does some additional magical things on top of that. But then when you're using that ChatGPT, you're using it in a generative way. You're not really playing with the model directly typically. There are ways you can fine tune it further for domain specific uses, but ultimately you could think of deep learning almost as like the operating system, and then you're using an app on top of it. Whereas before it used to be more closer to the metal.
So going back then to what we were thinking about this, is it making up something completely novel? Is it creative in that way? And that's an iffy word, but versus kind of exploiting prior data points and taking the next logical step. We all know that I can put in the same prompt several times and I get different answers, but I often think of it, and it would be great to know if this is valid way of thinking about this. It's a little bit like if this were a univariate progression, so I could even plot it, it's a two-dimensional space. I would have these data points, and let's say it's kind of a slope, and they look like that, like a cloud. And now ChatGPT is telling me what could be the next data point within what we've seen already. So it could be different data points that it picks, but it's kind of the next logical step. And if it's in the creative space, like rhymes, as you say, it will give me an answer, how I could finish this sentence or something like that. And I'll say, oh, I could never have thought about that. But it's actually like very logical. Like if you would run this human civilization as a simulation of what would be the next combination between biology and economics and next innovations. Well, there's a set of them that are possible, but it's quite logical that somebody's going to come up with connecting this insight with that insight in this other field, kind of the next interdisciplinary leap, so to speak, and that's how you can therefore predict it. But it's very kind of logical. It doesn't like go outside of what would be already the path, so to speak. Is that a reasonable way of thinking about it? Like it looks creative, but in the background, it uses those prior data points in that way.
I think everything you said is completely correct. One wrinkle in it, though, is you can prompt it to be crazier, right? Like you can tell it, think outside the box. So yes, it's logical. It's ultimately all deterministic, and it has certain probabilities, and then it just draws from those probabilities. That's definitely true. And you could think of it as a glorified autocorrect, right? That is what it is, for sure. But you can give it prompts like, come up with a unique idea unifying biology and economics that no one's ever thought of before. So then it would try to logically do exactly what you said, which is get to that, which might be a new insight, which raises this question. If it gives you a new insight, did it create it or did you create it? And I think that's the right way to think about AI is it's not going to, we're used to thinking about tools that give us answers, right? And we've been using search for Google and all those other things for 30 years, which has conditioned us to change our question to the type of question that search can answer. Ask search, it gives us an answer, right? Like we want to, what do we want to do? We want to make a nice meal for our family. But you can't say, Google, give me a nice meal for our family. You say, well, what's a recipe for this? Or what's a typical style of dish? And then you eventually come down to a kind of answer that answers the specific question of how do you cook or whatever, right? But that's because we've conditioned to change our broader question to a narrow question that our given tool can answer. Maybe ChatGPT and its ilk can be in the same way. It's a helpful tool, but we have to start thinking about it more like we're talking to a human being. And you can ask it more general questions. I want to make a nice meal for my family, and it can help you. Think of it as like a robotherapist or something. Where it's reflecting yourself, but it's trying to help you come up with a solution, which is a nice way of thinking about this. But it's consistent with everything you said.
Yeah, well, that creates a good bridge then to think about how this is being applied in the finance space, because I think of there being a really interesting world out there where you can you have to be creative, come up with a prompt that makes it think outside the box versus just going to the first logical steps. And here's what I'm thinking about there is anyone who says you will come across people saying, oh, we do AI finance or we do AI trading. It's usually the parameters are quite set. Like we beat the S&P over the course of the next 3 days or maybe 3 months, maybe longer with this AI tool that we have that is really, really cool and smart. That I'm thinking is, it's a little bit like, hey, I'm running a regression, different factors, swapping out different factors, how they change over time. But there might be other more interesting applications. But if maybe we start with that one, like, is that a fair assessment? It is certainly what we're seeing mostly in the space, right? If you come out with anyone saying, I do AI finance, it's often like they set the parameters of like what it means to be successful, and then use AI somehow to like beat the market, whatever market they picked.
That's right. And that's typically using AI in its original synonymous sense with machine learning, where you have a bunch of finance is beautiful for having enormously clean and comprehensive and deep data. So if you have all that and you're trying to, exactly like you said, find something that matches your objective function, maximize the Sharpe ratio, maximize the backtest, conditional on certain things, whatever you want to do, it is a form of data mining on steroids. Now, the nice thing about machine learning is that it has a lot of built-in mechanisms to prevent overfitting. Not least of which is the general approach where you have a train set, a test set, a holdout set, validation set. You do all sorts of things to make sure it's generalizing and not overfitting to noise. That is the number one issue with finance, is the wonderful amount of data is both a blessing and a curse. That's one kind of approach of using AI, ML, whatever you want to call it. Another approach is using AI more as a tool to try to help you create new inputs. And this has been around for a while too, just getting sentiment analysis from earnings reports or conference calls or anything like that. So you have a bunch of text, you're trying to get it into numbers that you can then use whatever other fancy machine learning tools you want to use as an input. That's something where the generative AI offers a different way of doing things. So instead of using standard natural language processing, you can give a few examples as a big prompt and say, this, I think, has very good sentiment, let's say, or I think this is bullish or bearish, or whatever you want to do. You get a bunch of examples, some good examples, some bad examples. There's a lot of, like you said, impact and marginal value to creating and crafting better prompts. And AI can help you with prompting, right? So you can tell it, helping craft a prompt that does this sort of thing. So it can do that too. It's a brainstorming buddy. That's another way you could do it, is to try to use AI to generate new data from unstructured data. That's a different way. And a third way is it can help you brainstorm a strategy per se from first principles. And here's what I believe, and here are the factors that I think matter. Let's try to work together to come up with, almost help you write. It doesn't have to be a full academic paper, but it doesn't have to be a full mathematical proof, but maybe a structure or framework to make sure that you're not contradicting yourself.
Well, this goes very much to the topic of market efficiency then, because if we're thinking about like a weak form of market efficiency, like the obvious thing that I could throw out, like AI, I have an AI that uses historical data that comes out with what the market is going to do next. And then the next level that would be what I feel like you're going into, which is use public information. And now all of that gets incorporated and we might interpret it differently, but it becomes like stronger market efficiency in that way. Is that fair to say? And it could be, well, I'll stop there and I have some other thoughts.
If you're looking for a needle in a haystack, and the needle is not obvious to anyone who can find it, it requires computational effort, then there are returns to finding. If you're the only one who can find that needle, you should earn outsized returns. Market efficiency is a very strong assumption. In fact, it's so strong, I wrote a paper about this also like 15 years ago, that if markets are fully efficient, if the efficient market hypothesis is 100% accurate, that means that P equals NP. P and NP is a computer science unsolved problem, meaning if you can check if a solution to a difficult question is accurate, is valid, that means you can generate solutions. That means if you can recognize a Renoir, you can paint Renoirs and so on. Most computer scientists believe P does not equal NP. Most finance professionals believe that markets are more or less efficient. They can't both be the case. This is especially highlighting to your point, now that, say, there are new tools out, not everyone is able to wield them at the same rate. So the data is available. So you have, let's say, earnings reports. People have been reading them. They've tried to squeeze everything they can from this. Goes back to the thing we started at the beginning, right? That maybe there's only one path, there's only one truth with lots of paths to it. But maybe there's additional insight that's different from conventional truth that AI can help you determine, maybe little subtleties in the way they use words, or the way they change tone over time that might indicate something is happening. Perhaps there's some value to extract from that. It could be the case that there is some value. AI wielded correctly with the proper prompts and done on all the data sets and correctly back tested might give you a boost going forward. That doesn't violate market efficiency. It just means that you have extracted information from public data that itself, the analysis is not private. So market efficiency assumes that once data is out there, then all computation based on that data is also in the public domain. And in a sense, that's true, but it's hard to get there. So if you have better computation, you may have a leg up.
This, I'm thinking this goes to very much how we think about are we talking about information? Are we talking about the analysis that comes out of that? So it's pretty clear that we can all say that data are generally like public. But data are useless until you create information by deleting most of that data, right? And then what you're getting into
That's exactly right.
What you're getting into is the analysis, which is basically creating knowledge out of that information, right? So it sounds to me like what we're getting at is that you're closer to, it's fair to say, and you can say that I'm wrong here, but you're getting closer to market efficiency by incorporating more of what was that public information into something that closer to informing you through your analysis. And we're now closer to people having one little bit of more streamlined analysis. People, come to the same conclusion what the information actually means. And therefore we do get more of, say, market efficiency, if it's the right term to use here.
I think we're always getting more and more efficient rather than less. But I don't think market efficiency is a one and done thing. Now we're efficient. And I don't think, even if we're getting towards efficiency relative to the amount of data and analysis, I like the way you put it, is extracting both information and knowledge in the hierarchy and extracting that and then making money. It's the same as any knowledge. A theory tomorrow can upend everything you thought you knew. So you could have an insight tomorrow that nobody else on earth has ever had and suddenly create new ways of making money in the market. That your activities then would make the market even more efficient than it had been, but that doesn't mean it wasn't efficient relative to what it was at the time. This could be splitting hairs. I mean, ultimately, what are we saying? We're saying there can be ways of making money in the market, or at least there could be better ways and worse ways. You can take more risk or less risk. You can take it at times when it's appropriate to do so, or at times when it's less appropriate to do so. Same as with sports betting. You can have an edge but you can over-bet or overbet or underbet the edge relative to Kelly. There's all sorts of things that go into trying to make money. And ultimately, I think what everyone cares about most is not from the perspective of the market. That's a kind of academic thing. Do we care if the market is completely efficient? I mean, it's a curiosity. Ultimately, we're looking at what can we do for our families to retire well, to make sure we have enough money for the future, to plan what we can do, to make sure that the economy is not going crazy with inflation and all these sorts of things. That's the different perspective. It's not from the market as an ivory tower thing, but it's from the human being perspective. Can we use these tools, even AI, to make our lives better?
Yeah, I do want to get into those more human aspects. So before we leave the academic, so to speak, discussion, though, you did mention briefly how to kind of formally think about, is there even market efficiency, right? This P versus NP. So maybe we should just kind of explain that, and like, what does that mean in terms of what you could say, like, what that means for whether markets are can ever be efficient, and if that is even a meaningful concept.
Interesting. Yeah, so P and NP. P is the set of class of decisions that you can solve in polynomial time. So if we sorting a list of numbers, if I give you an additional number to sort, how much longer is it going to take you? It's polynomial. It's not that, it doesn't grow that fast. So people typically think of this as computational efficiency. Those are efficient algorithms. Some problems seem to take at least exponential time to solve. Like the traveling salesman problem. Can you visit every city given on a map, given these distances, visiting each one only once? Or knapsack problem. Can you fit all of these things into a knapsack? Or satisfiability? Or there's a lot of different general classes of NP problems. The N doesn't stand for, the N stands for non-deterministic polynomial. In other words, if you guess a solution, if I tell you here's a map and here's my proposed solution for how a salesman can travel to each city, you can very quickly check to see if it's accurate. But finding that path can be very, very difficult. And that's the divide between efficient algorithms known to be efficient polynomial time P and algorithms you can solve it, you can check the solution efficiently, but finding it is not known to be efficient. Although there's lots of heuristics for getting it done in practice really fast, but in general, we don't know if the two classes are the same. And most computer scientists and mathematicians say they're not the same. It's one of the biggest open problems in all of mathematics and computer science. If markets were efficient, the point about market efficiency, it's a ridiculously strong statement. If the markets were 100% efficient perfectly all the time, there's a way you can encode any, let's say, traveling salesman problem into a series of orders in the market that, to the extent that market is trying to extract as much possible value from your orders, if it is able to fill those orders in a particular way, that means there's a solution to the traveling salesman problem or anything else is one way versus another way. So if it can tell you a solution, it can find a solution. And it goes back to the other way of thinking about things, which is it's when information is available or data, is the knowledge instantly available to everybody as well. Market efficiency implies that, yes, it is. Any insight that can be generated from the information is also priced into the market. And I don't think I don't think it's possible for that to be accurate, because we can't predict the growth of knowledge, is another thing David Deutsch says. If you knew what future knowledge would look like, it would be current knowledge. So we don't know what we're going to learn tomorrow. So it can't possibly be the case that everything possible to be thought about is already priced into the markets.
And it would be basically require that if you're going to get to the peak, there's only one path to get there.
Interesting. The peak meaning market efficiency?
Well, the analogy of like how to solve a problem, if there are different ways of solving a problem, this P versus NP can't hold for what you're describing. Like, it's like, oh, well, if we have all the information, there's only, like, ChatGPT would give me only one possible answer to get to where I'm going. I'm thinking about this a little bit like, yeah.
No, go ahead.
No, I was thinking about this a little bit like public and private keys in the world of codes and hidden information that way, as it's been applied to the blockchain world as well. Like it works because you can have a private key. The private key is what you
That's
use to
exactly
say,
right.
"Oh yes, that's the answer," but the answer would not giving you the question. So.
I like that a lot. If you think of it that way, then if P equals NP, then you'd be able to mine Bitcoin much better than anybody else. You'd be able to break all encryption and cryptography, right? So that we know that that's not true, at least in the current world, right? No one has come up with such an algorithm, so the markets can't be fully efficient 100%. But market efficiency, again, it's not, it's like many things, it's an ideal, it's a way of thinking about things that help you simplify, and it's a reasonable tool to help you simplify thinking about things. Like something happens, a war breaks out, or there's a famine somewhere, or there's a change in prices, or the Fed says something. Is that priced into the markets already, or do I have a shot? Well, it depends on when it happened. If it happened 15 seconds ago, then it's probably too late. Right? If it's about to happen and you know before anyone else, then maybe. But most of the time, most things are priced in, and it's not because market efficiency is some puppet master. It's because of the individual actions of human beings who are trying to extract as much information and knowledge as they can from the given data to do what's best for their families, and they move prices by Adam Smith's invisible hand to a place where they are now indifferent to trading more. Right? You've changed the marginal purchases of everybody to a new plateau or a new level where everyone is sort of comfortable with the current price. If you have a just different opinion, you need to justify and back it up. It's probably reasonable to say, well, that part's already priced in. Everyone knows about the war. What's the new insight about the war or about inflation, whatever? So it's a good test on yourself to say, what do I know that no one else does, or why are other people willing to leave nickels or quarters or whatever they're leaving on the table? Why are they willing to do that?
Well, you can also say, like, I mean, this is like the impossibility theorem, right? Like, as long as you're going to act on it, there's recursion in the system. So here you go, complexity, and therefore you can't solve it, right?
Oh, that's interesting. Yeah, it could be that it's completely unsolvable. That's right.
So, but you got into a little bit of the human side of how to think about this. I mean, you often hear, like, well, AI cannot solve my family problems. It can't do this, and of course, that's an easy stab at it. But I think it's interesting to think about areas in finance where AI, machine learning, whatever you want to refer to, can solve more than just beating the S&P in a certain period. We haven't answered the question of, like, why would I want to beat the S&P at all? Why not some other market? What should be my portfolio in the first place for me as an individual? And what should be, more importantly, maybe the time horizon of that? Why did you pick a week, or why did you pick a year? Is there what is there out there that you might be thinking about that where we can actually use AI further? There's one way of thinking about this, right? Is the implementation versus like alignment. So people say, well, I can tell it to solve a certain question, but it doesn't know that I want to, as a human, say, be alive and be healthy and be wealthy. That's the alignment question. Is it's incentives is not in line with mine, so to speak. And I'm thinking that the open field is finance, if possible, is to start nibbling at some of those alignment questions instead. It's like, okay, so if I'm going to have this family, what should my portfolio be? Well, it becomes very much like on an individual basis, more of application in wealth management.
It's a lot to unpack there. You're right. You can prompt the AI, right? You can tell it, I would like to be happy and healthy and wealthy and whatever. And here's my thoughts, and can you help me craft a way of thinking about things? But I want to get back to the earlier point you said, which I think was really clutch and key, that what is your objective? That's something ChatGPT can help you a little bit, like a sounding board, but ultimately, what should your objective be? How do you trade off, let's say, 99% chance of having enough money to retire versus a 1% chance of going broke, versus let's make that 70% chance of having enough money plus a certain excess that you can change your lifestyle or you can bequeath to your heirs or whatever you want to do, versus a 30% chance of going bankrupt, right? How do you make that trade-off? Which one are you more comfortable with as a human being? And again, it's from a human perspective. That's a different question from, let's say, looking at a society where 70% of people, for you, it's 70% of your life. You only get one draw of time. You only get one life. So there's a 30% chance that your life will end in bankruptcy. So how do you make those kind of objective trade-offs? And I'm not sure how the best way to do that. I know that one important consideration is risk. You have to think about how much risk you're willing to bear and can you manage that risk over time. Like the S&P. The S&P is a very passive index. You just, it seems like you're making no decisions, right? And in a sense, you feel like you're taking market efficiency out of space. I don't know any better than the market. Forget about beating the S&P. I'll be happy to just capture the S&P returns, and I'm willing to take the risk because over 20-year periods, 30-year periods is very rarely gone down, whatever you want to say. On the other hand, the S&P itself has a varying amount of risk. It's far from passive. There are periods of time, regimes, when it's substantially more volatile than other times. And when it's substantially more volatile, those periods are the ones that are going to dictate your overall lifetime performance much more than the other seemingly equal time periods, but the volatility is much lower, so they have much less of an impact on you. One way of thinking about that, this is one of the insights of Myron Scholes and Ash Alankar, who run our asset allocation group at Janus Henderson, is the idea of time series diversification. We're all comfortable with cross-sectional diversification, right? You don't want to put all your eggs in one basket. You'd like to spread out at a particular given slice of time. You don't want to put everything into NVIDIA or Apple, Microsoft. You want to spread it out across lots of different stocks and assets classes. But it's also the case across time. You don't want to concentrate all of your bets onto just one period. Because if you passively invest into an index, that is what you'll happen. You'll end up concentrating all of your risk. You're better off when risk is high, reduce your exposure. When risk is low, maybe expand your exposure so that your risk is constant. You have a passive risk exposure, which means you might need to trade dynamically. That kind of insight, I don't think AI would be able to generate. It's the same as asking it to generate E equals MC squared before 1905 or any other kind of big idea. But given that we have this idea, I think it's reasonable to use AI to help you decide what is your level of risk tolerance. How much drawdown risk are you willing to bear in order to accomplish your desired lifetime payoffs or lifestyle when you retire, or whatever other your risk objectives and financial objectives may be.
So is it fair to think of this as a diversification of time horizon in addition to your diversification of assets?
Not so much time horizon, but time periods. So, so when the market right now, the market, let's say, is relatively low volatility, but there was a period of time not too long ago when it was very high volatility. If you have $100 invested in both periods, then your overall volatility across both periods will be almost entirely determined by that first period. So maybe in those kinds of regimes, when the market is topsy-turvy, you want to reduce your exposure. And when the market is less topsy-turvy, you want to scale it back up so that your risk exposure becomes a little bit more constant. Now, which risk? Should it be just volatility and symmetric risk, or should it be the downside risk? I think what we really care about is diversifying the downside risk.
So when it comes to that, understanding, as you refer to risk, there could be like a time horizon. If I'm investing in the long run, I'm fine with certain periods of high volatility on the way to the goal that I'm looking at in 50 years time. Or in the, say, wealth management space today, people quantify a lot of those things, right? They do it by asking questions. Obviously, an AI, without knowing who the AI is interacting with and referring to, will not know what's your risk tolerance. But isn't that something that is already kind of done out there in terms of if I tell the AI that I have this risk tolerance, or if I tell the AI that, I have this time horizon, I think I'm going to, this is roughly my income right now, I think it's going to grow by this, or how much uncertainty is it because I'm an entrepreneur versus government employee, and I have this big payment coming up in 10 years when my kid is going to college or something like that. isn't that already kind of put in whatever rudimentary models that are out there? And wouldn't you just put in the same thing in AI and help it align, therefore, your say lifetime utility, or however you want to think about it?
Two thoughts on that. One is, yes, of course, everything is already in the AI, and it can simulate a wealth manager for you. Now, typically, wealth managers and AI, they tend to focus almost exclusively on static allocations. They can spend a lot of time asking you questions, and they'll say, okay, you should be 62% equities or 58. Whoop-de-doo. It's a fixed static allocation. They don't typically think about a dynamic approach where, well, depending on the market conditions, maybe you want to be 60% or maybe 20% or maybe 80%, right? That kind of dynamism, I think, is incredibly important for managing risk, but is not something that is very easy for AI to conceive of because it's not really part of its training corpus. It's not something that is conventional financial advice. You'd have to really prompt it in that direction substantially. I'm sure there's a way. I think ChatGPT is essentially Turing equivalent. Anything that can be computed by large language model because it has access to Python and everything else. So there must be a prompt that would give it the sort of answer that I think would be more reasonable. But I don't know what that is.
Yeah. I mean, don't you always risk falling into the portfolio insurance space here if we're thinking about, the contribution to risk was so much higher in this month because right now, like we're just looking at current information, the volatility is really high, and therefore you should pare down the allocation to this market that is really high. Well, we know that high volatility also often usually means that prices are going down in that market. So you end up with those strategies again.
Yeah, absolutely. There's no perfect strategy, right? There's no strategy that's guaranteed to make money. That'll be arbitrage. But there are strategies that can give you the sort of risk framework and exposure that matches the sort of thing you're looking for. It doesn't necessarily have to make money in all cases, and it can't. But it can lose less in the exact periods that you're talking about. We know that when markets tend to fall, they tend to fall for a while. So if you can start reducing your exposure to those left tails, the power of the compounding will be enormous for you, right? If you look back at history, if you're able to just avoid the worst months or even reduce it by half, or if you're able to, without losing the participation in the best month or reducing that by half, those basically tell you everything. Much of your life, not just finance, but your life is in the tails. It's not so much in the middles. So what matters the most is tail risk management. Are you able to reduce the really big losses, and are you able to participate in the really big gains? If you can do that, however you're doing it, it sounds, once you phrase it that way, pretty clear that you has to be something dynamic, right, rather than this kind of static allocation. If you're able to do that, your rate of growth, your compounding will take off. It's like rocket fuel. It's just fantastic. So AI can help with brainstorming. It can help with extracting information from yourself about what are your risk methods. It can generate certain kinds of wealth management or static portfolio ideas that maybe you can consider. And prompting, maybe it can also help you think about dynamic trading. But I think it's more of an internal mental shift rather than what the AI can do. Is, are you comfortable to be aware that what matters is risk management more so than chasing whatever the hot deal du jour is, right? If you're looking for, you can distinguish it between a search for alpha and a search for risk management. Alpha is, let's say, excess expected returns. Where is that coming from? That's where all of the market efficiency that we've been talking about is slamming it into the ground. Market efficiency says there should not be any excess expected alpha, right? If there is, you're bearing some additional risk that no one else is willing to bear. But that says nothing about the possibility of reducing risk. Just managing risk by dynamically trading doesn't affect the efficient market hypothesis at all, but it can have an enormous benefit to you as an individual.
Right. What do you think is going to be the impact on the industry from this? There's obviously a very uneven adoption across the board, different firms doing AI, and I don't know, like, what's the most kind of cutting edge and impactful? Is it the more beat the S&P here, or what we're talking about now, something that it doesn't try to get to the efficient market kind of feel that we're talking about. Do you think that we're going to see a big like bifurcation here? Like some firms that have a big capital already are going to get all the AUM, so to speak. Like people in the economy as a whole, right, are worried about AI concentrating wealth because some will control it and understand it, whereas the other ones are left behind, and the technological shift goes so quickly that you get big inequalities. Do you think we're going to see the same in finance, or do you think thoughts about the dynamics there?
What would it mean? What would the opposite mean? Suppose everybody had completely equal access to all of AI and all the insights that were ever available to in some exact proportion that is dictated to be fair. What would that look like? Right now, everyone has access to the internet. Does everyone use the internet the same way? Does everyone use CPUs the same way? Does everyone use Excel the same way and Python the same way? No, these are tools that intelligent people harness to solve problems. People differ in what problems they're interested in solving. And institutions differ in the kinds of problems they're offering to solve for clients. I don't know what's going to happen in the future. If I did, then we would all know it, right? By market efficiency. I don't know. That everything tends to get concentrated just naturally. If you find there's a particular type of mathematical model, let's say geometric Brownian motion, that's valuable for derivatives valuation, and suddenly people who are experts in that, even if they're from other fields, say physics, will suddenly start to get attracted to, but through money, but to specific firms that invest more into it. And some firms will specialize in that, and others will specialize in other things. And I think that's fine. There's a difference of opinion. I don't know whether it's 50-50 or 90-10, and I'm not even sure in which direction, of whether AI will end up helping finance enormously or be just a blip on the radar or somewhere in between. I think it's such an amazing and incredible innovation that if we're unable to use it, that's on us. There must be some way of using it. Now, to your point, it's really hard to create these foundation models yourself. Obviously, you have to it takes an enormous investment to make a really good one. But there are open source ones now from Meta available and others. So you can have all of the weights, then you can fine tune it or do whatever else you want to do with it. It's a fairly level playing field. It's not completely level. It's really hard to compete with OpenAI or with Anthropic. These are behemoths, right? Or with Microsoft. But the goal isn't to compete with them, but to use, like you don't have to compete with Google in order to benefit from search. Similarly, you don't have to compete with OpenAI, and you don't have to be the main insights, I think, will still come from human beings on how to use AI to solve interesting problems in an interesting way, rather than it being a commodity that some people will hoard more than others. Because if it's a commodity, if we know how to extract value from any particular thing, then everybody will do it until it becomes marginal value relatively close to zero, right? So yes, there could be different specializations, there could be different focuses across different firms, but that doesn't mean that we're going to have one person with all of the Earth's wealth or anything like that, I think.
Yeah, I mean, it's certainly the case now that like the economics research, just like outside of finance, has a mixed bag of deductions and outcomes, and for me, it seems logical that like the way that most people are familiar with ChatGPT and such its tools is that, oh, well, I can now have a firm where all of a sudden I got the marketing done, I get the slide deck done, I get like all of these things that in the previous times I would have to save up $1 million to start my own firm so that I could have different, people working under me, and all of a sudden I can not necessarily be the best, obviously, and there's some fine tuning that needs to be done maybe on the output, but like I can be pretty good without spending the capital that I used to spend. Now I can have one person, handling my prompts, and that's enough. So.
Yes, you're right, and especially that feeling that they're not going to be quite the best. So the way I think about AI is, so I do research with Dr. Ellen Langer. She's the mother of mindfulness. She was the first tenured professor of psychology at Harvard. She has a new book out called The Mindful Body and how mindfulness can affect your health and life and everything. And she's been doing research on mindfulness for almost 50 years. And we're writing a book together. We've written some. research together. One way of thinking about AI is it's turbo mindlessness. It's like having a bunch of mindless people working for you, right? You can have a marketing department full of relatively mindless, they'll do their job, right? They'll get your copy out there, right? They'll do everything you want. But they're not typically generating new insights. It's not going to be like, hey, Lotta, I have a great idea for how you should change your business and do this, right? No. Go back to work. Go do your copy editing or whatever you do. So if you think of AI as a way of providing mindlessness, outsourcing mindlessness away from what we as humans have to do, now you're freeing up yourself and whoever else you do have to hire, if anybody, to do the more mindful and interesting things, to really find what is the problem. Do I want that problem? Can I change it to a different problem? What is my objective? What can I do insightfully? And then the specifics of execution as soon as you can explain to a human being, let's say a fresh undergraduate or even a smart graduate, right? Here's what I need you to do and just go do it like a drone. Then you don't even need that undergraduate, right? You could just have the AI do it. And then you can spend your time hiring the students for their innovation and creativity.
Yeah, no, that's absolutely right. So thank you so much for a fascinating conversation. Anything else that, I just want to ask you, maybe in closing here, for people interested in this field, they think they're very smart, they want to do something a little different. What are you excited about seeing out there, and what should people be less obvious things related to AI finance that people should be looking out for, or maybe research themselves?
I think the most valuable thing to do is play with the models, as many of them as you can, as much as you can. We typically think of models as something that we need to tune to adjust to the way we think about the world. But a better way, the models are kind of mindless, right? But we're mindful. To the extent that we can play with models, we can change ourselves to come up with new ideas. I think that's more valuable. The same way as like with the internet search, when it first came out, there were people, to this day, people don't really understand how to do it, right? They type, how do I get to yahoo.com or whatever, right? There still can be disconnect. But if you start playing with it, you start to develop a visceral feel, and that can lead you to new insights and knowledge. There's something that's been happening for the past year and a half or so. People try to make agents with AI. They're AIs, but they try to go do things. They try to browse through the web or balance your checkbooks or whatever you want them to do. And they iterate, they recur, like you said. I haven't seen any huge, awesome payoffs of it, but it sounds really interesting. And the more you delve into these kinds of things, or delve, by the way, is usually an indicator that what you're reading or hearing or seeing is generated by AI. People don't usually use the word delve as much as AI uses the word delve. But in any case, to the extent that you can play with these models as much as you can and build your own intuition about what's possible and not possible, I think that has enormous returns to scale. It's not that there exists a solution right here, and here's the golden chalice, and nobody is using it, and go ahead and use it. It's more like there's this ocean of interesting things that if you're Magellan, if you go out and explore it, you will find something that nobody else has found.
Fascinating. So that would be, when you talk about agents, that's like agent-based models, but fueled by AI as opposed to your equations.
Yeah, they're not models. They're programs that run and do things for you. Like imagine you tell an AI, go out and build me a web app and iterate it and manage all the customer service. And right, it's not a single prompt. It's always recurring and trying to do more things.
Yeah, fascinating. Anything you want to say about, in closing here, about your current work, whether in industry or your academic pursuits, that for people who want to follow you and think this conversation is interesting?
Oh, feel free to reach out to me anytime. I'm happy to talk about this stuff with anybody. I think there's a lot of interesting things happening in finance, in AI, and in general in the field of analytics, where the important thing is less and less about the skills and the techniques and the technologies for all of these things. And it's more about understanding people's desires, needs, and objectives, and finding ways of solving problems. In other words, being mindful is is the secret sauce, right? To the extent that you can appreciate uncertainty, these are all insights from Ellen Langer. Appreciate multiple perspectives on the same things. Be in the moment, right? It's notice new things and wonder why you hadn't noticed them before. Appreciate uncertainty and risk. Those things, I think, they've always been valuable throughout history. That's where all creativity and insight and wonderful progress comes from. But now we have an opportunity to really, turbocharge those.
Yeah, fascinating. Well, thank you so much. Thank you so much for joining us today.
Thanks, Lotta. It's been fun.
It was a lot of fun, and thank you everyone for tuning in. This has been the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. Our guest today was Philip Maymin, and we will see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.